So our next 4 chapter videos will cover chapters 7 through 10 of our book, Next Gen Dollars and Cents. So these chapters are the chapters that really focus on explaining the 4 most common options when it comes to investing your money to accomplish your financial objectives. Chapter 7's focus then is on stocks. So owning a stock means that you have ownership in a company, and stocks are typically issued to raise money for expansion or funding the operations of that company. When you buy stock, in essence, you become a shareholder or owner of a small part of that company in proportion to the number of shares that you own relative to the number of shares that that particular company has issued out. Publicly traded companies, which is the ones that we all kind of think about, the companies like Microsoft and Amazon, are bought and sold on stock exchanges like the New York Stock Exchange. So when you're a stock and you're listed on the public exchange like that, anyone can buy and sell shares in that particular company. Because of that, and because of the availability of owning those shares to anybody and everybody, then certainly publicly traded companies have a variety of regulatory requirements, financial reporting requirements that they must observe. In contrast, private companies are owned by small groups of individuals, such as maybe the founders or management, and their shares are not available to the public because they are not traded on any stock exchange. So 2 of the main sort of actions that can impact a company's stock are the notion of paying dividends and stock splits. So dividends occur when companies pay a portion of their profits out to their shareholders. Obviously, those dividend payments are in proportion to the number of shares that you have. So if you own 1 share versus 10 shares, you're owning 10 shares, you're going to get more of a dividend payment, because the dividend payments are generally announced as a certain amount per share. That's how dividends are typically paid by companies. Another sort of action that you might see involving a company stock, as we mentioned, is the notion of stock split. So a stock split occurs when a company increases its outstanding shares by dividing each existing share in to multiple shares. So for example, a 2-for-1 split, 1 share becomes 2 shares. And that type of action of stock splits typically occurs when the value of a company's stock has increased to the point where it just isn't affordable for small investors. So it doesn't change the cumulative or total value that one has at that particular time. It just changes the amount of stock that's outstanding and consequently the price per share of an individual stock. So those are sort of the 2 things that you hear as it relates to stock, dividends, and stock splits that can sort of impact those shares and what owning those shares of a particular company is all about. In terms of measuring the value of a stock, the book talks about 3 main ways in which to do that. So you've got price earnings analysis, you've got quantitative and qualitative research, and then the last category is standard deviation. So to go to the first one, that price earnings analysis, the price earnings ratio, the PE ratio, as you may hear it called in the media sometimes, it's basically a financial metric that conveys what a stock's valuation is by comparing its current market price, that's the P part, the price part, to its earnings per share. And that ultimately creates the price earnings ratio, the PE ratio. And so by comparing PE ratios of companies that are sort of within the same industry or market segment, it allows investors to assess the relative value of potential investments. if you look at the other way to measure the valuation of a stock, that's this notion of quantitative and qualitative research. Qualitative research focuses on like companies' management, its competitive advantages, its products, things like that. Quantitative analysis, on the other hand, assesses sort of a company's financial performance, really just kind of looks at the numbers. And then the third way to measure the value of a stock is by calculating its standard deviation. Now, standard deviation represents the volatility or risk associated with a stock by measuring sort of the distribution of data points, such as the actual returns of that stock itself, from the average. So when you think about standard deviation, it looks at how much does the performance sort of swing or vary relative to kind of what the average performance is. So those are the sort of the three ways that you can use to determine the relative value of a particular stock. So the book next shifts gears to sort of talk about the three main market indices that are out there that we hear so much about. And just for understanding purposes, a stock market index tracks the performance of publicly traded companies representing either a specific market segment or a broader market as a whole. So the big three that most people have heard about are, number one, the Dow, number two, the S&P 500, number three, the NASDAQ. So we'll take some time to describe them a little bit more in this video. Obviously, our book, Next Gen Dollars and Cents, contains a lot more description about what each of them are, along with a table that we think is pretty helpful. So you can see kind of the difference between these three different market indexes that are out there. But first one, the one that most people know and refer to as the Dow, is actually the Dow Jones Industrial Average. And it is an index that tracks 30 large publicly owned companies that are sort of reliable industry leaders referred to as blue chip companies. But it's a collection of 30 companies. It was first published in 1896. And it's one of obviously the oldest stock market indexes in the world. The second market index that you hear a lot of people talk about is the Standard & Poor's 500 index, otherwise known as the S&P 500. That is a broader stock market index, obviously, than the Dow. The Dow, only 30 companies. The S&P 500 is tracking the performance of 500 large companies that are listed on U.S. stock exchanges. When we think about the Dow is calculated sort of using a price-weighted approach. The S&P 500 is calculated using a market capitalization approach, which means that its value is sort of directly correlated to the value of a particular component stock price. So what that means in English is that companies with larger market values will have much more of an influence on the performance of the S&P 500 as a market index. The third one, often known as NASDAQ, it actually stands for the National Association of Securities Dealers Automated Quotations. Now you know why they refer to it as NASDAQ instead of that full title. That is a global electronic stock exchange. Founded in 1971, it's one of the world's first electronic stock exchanges. So those are the three main market indexes that you hear a lot about. There is one particular sort of hybrid type of investments that we talk about in this chapter on stocks, and that is exchange-traded funds. Now, also known as ETFs, they're investments that are traded on exchanges in the same manner as individual stocks. So that's kind of why we put them in the chapter on stocks. But an ETF also shares many characteristics with a mutual fund. And so the video that we'll have a couple videos from now, chapter 9 of our book talks about mutual funds in much more detail. So you'll hear a little bit more conversation about that. But typically ETFs are designed to track the performance of a specific index or a particular industry sector. In terms of sort of the concept of owning stocks, obviously owning stocks offers investors the potential for profit through share appreciation and dividends, but it, as with anything, comes with some risks. So in the book, we describe sort of 5 of the most common risks of owning stocks and individual stocks. And of course, first among them would be company-specific risks. Those would be the kinds of events such as a change in management, a lawsuit, financial difficulties, maybe a bad product that can impact disproportionately the performance of that particular company. Second on the list is, of course, the inherent volatility. Stocks are more volatile, meaning that their prices fluctuate more than, say, cash. And ultimately, the return over time doesn't follow kind of a smooth linear path. There's a lot of kind of ups and downs to it as well. Liquidity risk is another risk of owning stocks, particularly if it is smaller or lesser known companies. Liquidity risk simply refers to the ease with which an asset can be converted to cash. Currency risk is also another risk that can occur when you own stocks. That risk has to deal with if you're buying stock in foreign companies, whereby those earnings or the price of that company gets translated back to U.S. dollars, and ultimately, if the relative value of those currencies are shifting, then that's another risk in terms of the performance of that investment. And then, of course, the last on sort of the 5 described risks in the book on owning stocks is the risk of inflation, which is pretty much a risk across the board. Inflation, very simply, is the rate at which prices of goods and services increase over time, thereby eroding the purchasing power of your money, and that value of that money gets eroded over time as a result of inflation. Chapter 7 of our book, Next Gen Dollars and Cents, finishes with sort of a highlight of some of the pros and cons of owning individual stocks. Among the positives of owning individual stocks is the notion that you've got the potential for higher return, right? A particular stock could certainly outperform the overall market at any time due to a company-specific event, right? Maybe they come up with a patent or a new product or new invention that ultimately drives their stock price much higher relative than to the overall market. Of course, owning individual stocks does give you a lot of control over what it is that you own on a regular basis. The downside or the negative to owning individual stock is obviously owning individual stocks comes with a little bit higher risk than a more diversified portfolio, and of course, the higher amount of time required if you're owning an individual stock portfolio. You should spend some time researching and identifying each of those individual components that you want to own. So overall, owning individual stocks can certainly be rewarding, since historically stocks have generated better returns over time than other types of asset classes. The reality is that we don't typically recommend sort of owning individual stocks, certainly for the vast majority of your assets, because of the complexity, the cost, and just the lack of diversification that can come with owning individual stocks. Our sort of preferred method of investing it utilizes mutual funds that focus on stocks. And certainly in our video on Chapter 9 that'll be coming up, that will have a much more detailed conversation about what mutual funds are and how they operate, and sort of the pros and cons of owning them as well. But bottom line, to gain a better understanding of stocks and how they work, be sure to read Chapter 7 of Next Gen Dollars and Cents. You can get a free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen dollars and cents. Thanks for watching this video.